Hello and welcome. I'm Amritanshu Rai and you're watching Law of the Land on Rajya Sabha TV. Today we bring to you the Direct Tax Code, which seeks to bring in the general anti-avoidance rules, granting great powers to the officer assessing tax. To discuss the issue, I have with me Sanjay Agrawal, Chairman, Direct Tax Committee, ICAI, and Mr. N. Venkatraman, Senior Advocate. Now for the headlines. The proposed law seeks to widen tax slabs for individuals, allowing them to keep more money for themselves, and also seeks to prevent tax evasion. The bill empowers the tax officer to allege tax avoidance, and the burden of proof otherwise will be on the taxpayer. And it proposes to separate computing of units of one business. The proposed Direct Tax Code seeks to simplify tax legislation to make it easier to comply with. It widens the tax slabs for income tax and seeks to prevent tax evasion. The bill introduces the concept of general anti-avoidance rules, under which a tax officer will be authorized to allege tax avoidance relating to certain entries.
The Direct Taxes Code proposes to introduce general anti-avoidance rules for the first time to prevent revenue leakages. Under this, the tax officer will be authorized to consider an entry as tax avoidance. Once this question is raised, the burden to prove that it is not tax avoidance will be of the taxpayer.
I don't see how it is going to make things simple, easy to understand. It will only make life difficult for people, A, to understand the new provisions of the code, B, that courts will have to interpret it once again, C, that there are several provisions in the code which are bound to promote litigation. And I would also say that the code is fairly one-sided, more inclined towards the tax gatherers, leaving very little headway available with the assessees to litigate their point of view.
The tax slabs under the proposed bill have been widened to benefit individual taxpayer. Let's take a look at the existing slabs, the proposed law, and the recommendations of the Parliamentary Standing Committee. The existing slabs of income tax are 10% on income over 1.8 lakh rupees up to 5 lakh rupees, 20% on income over 5 lakh rupees to 8 lakh rupees, and 30% tax on income above 8 lakh rupees. According to the Direct Tax Code proposal, individuals will have to pay 10% tax on income between 2 lakh rupees to 5 lakh rupees, 20% will be levied on income between 5 lakh rupees to 10 lakh rupees, and 30% tax will be levied on income above 10 lakh rupees. But the Parliamentary Standing Committee recommends further widening of tax slabs. According to the recommendations, personal income of 3 lakh rupees to 10 lakh rupees should be taxed 10%, income over 10 lakh rupees to 20 lakh rupees should be taxed at 20%, and income over 20 lakh rupees should be taxed at 30%.
That GAR panel, which presently will consist of, as per the proposal, will consist of only the commissioners of income tax. It may not be fair.
The code proposes to add all perks enjoyed by a taxpayer to income for the purpose of tax calculations. In other words, allowances like leave travel, furnishings, entertainment expenses, conveyance, medical etc. will be added to income. The Direct Tax Code will replace 50 years Income Tax Act, but the concern is about its implication because it will give wide powers to the tax authorities. With camera person Virendra, Aruna Thakur, Rajya Sabha TV.
The bill does not specify what kinds of transaction may be characterized as impermissible, because of which there are no guidelines for assessors to avoid transactions which may be declared impermissible. Also, there is no safeguard against the misuse of such power. There is proposal pending in the Finance Ministry proposing to limit the operation of GAAR to transactions above a certain specified limit. My question to you is, Mr. Sanjay Agrawal, GAAR, as you see it, and the powers that are given, and also the proposals that are floating around in the Finance Ministry to limit it, even if all those are done, do you still see scope of GAAR going haywire?
You see, if we look into the first time introduction of any legislature, certainly there is a comparison between the offshore implementation of the GAR and the how it will be implemented in India. There is something on the back of the mind of the all you can say taxpayers are there that this will be used in this manner or that manner. But the rules for the GAR which are required to be framed yet, they are required to be framed looking into this fact very clearly that it is to be implemented in India and it has to be tuned in according to the you can see the availability of the mindset of the people over here and the various studies which are available over here and the type of the transactions which are entered in India. And I think this GAR is to be introduced in India, but due caution has to be there and it is to be implemented not so fast, it is to be implemented in a phased manner.
Mr. Venkatraman, my question to you is, you've seen GAR. The intention behind it is absolutely clear. The officer has been given more than enough powers. As of now, in the bill, we don't have any safety mechanism. There is no clause which says, which specifies the limit to which an officer can call an entry impermissible. Okay? Then there is no accountability on that officer. These 2 points are missing, and the Standing Committee has exactly raised these 2 points. How do you see GAR playing out in the Indian system without these 2 safety valves?
3 or 5 years from now, we will have the most complex tax litigation around the country, and courts will find it very difficult due to lack of time in disposing of these matters. I'll give you the background. From an era of tax evasion, courts have always said tax evasion is impermissible, whereas tax avoidance is not something which is prohibited if it falls within the realm of tax planning. GAR is the first step in India which makes it tax avoidance to be legally impermissible. It's the first step. That's the conceptual understanding we should make. Now you are left out only with tax planning. Now the difference between tax avoidance and tax planning is wafer thin. So what an assessee could think and do something as tax planning, it is so easy under the GAR provision for the tax administration to say it is an impermissible transaction resulting in tax avoidance and therefore the structure is not to be allowed. There are 3 areas. There are 2 parts to GAR. Part A is the law, the principle. Part B is the administration. As far as the law is concerned,
it's clear.
Clear, but it has 3 aspects. Two aspects at least I should highlight. Somebody talked about burden of proof.
Yeah.
It's in a tax in a tax law, it has always been the burden is always on the tax officer to prove a transaction.
Yes.
Now they have shifted that burden to the taxpayer.
Yeah.
In fact, Standing Committee suggests that it should get back to the tax officer. Let me even assume for a minute. See, why do they say that is important? They say the burden is on the taxpayer for the simple reason there are certain transactions which are only within the realm and knowledge and domain of the taxpayer, which we will not be able to reach. Therefore, they cast the burden on the taxpayer. You should come out with the truth.
Okay.
Fair enough. But the difficulty I foresee in the tax administration is when you come out and explain a transaction in all fairness and in a transparent and a justifiable manner, will the tax administration position itself and yield and accept that it's
whatever
a genuine
you're saying? Do you agree with that? Do you think that's a possible threat? And that is where the entire implementation bit of what he says or what he terms as tax planning will completely go haywire.
You see, always there is a tough fight between a revenue and a taxpayer that whether it is a tax planning or it is a tax avoidance. This is a thin difference which is the courts are interpreting from, you can say, last 50 years or 60 years. The only thing which this standing committee has also brought in this particular report which they have brought, that as on today, there is no judicial accountability on the assessing officer. If that is also brought in, then I think a balancing will be there. Otherwise, if it is only on one side, that you put me, that you discharge your burden, and I will keep on presuming anything what I want, then it will be very difficult to implement in such a situation unless until there is a also simultaneous introduction of the judicial accountability.
Right. I'll come back. It's time for us to head into a break. When we come back, we will talk about the proposal for separate computing of separate units of one big business. Welcome back. The proposed direct tax code seeks computing of separate units of one big business separately under certain conditions. This is being done to ensure there is no revenue loss to the government.
If there is a big bank, then it may have to file separate computation for different branches. In the present system, one computation of the entire banking business is required. According to the proposed direct tax code, separate computation of income of different units of the same business will be required if the business are different. Businesses will be considered to be different and separate if the physical locations of the two units of the same business are separate, different raw materials are used, or different products are produced in different units, and separate book of accounts are maintained or capable of being maintained.
It is not that every arrangement which will lead to a tax benefit should be disregarded, but the primary driver for every transaction should be commercial considerations. So if commercial considerations are there and can be justified in accordance with the specified rules, then the tax benefit should not be denied. But if the primary driver of a transaction is tax benefit, then the government will seek to take its own share of revenue.
The direct tax code seeks to make major changes in wealth tax calculations and rates. The threshold limit for wealth tax will be raised to 1 crore rupees from the present 30 lakh rupees, and the tax rate will be 1%. For the purpose of levy of wealth tax, taxable assets will include deposits in banks located outside India in case of individual and unreported bank deposits in case of others. This is a specific measure to detect black money. The bill proposes not to impose wealth tax on residential houses, commercial premises, and immobile property which is rented out. But urban land and farmhouses located within 25 kilometers of any municipal and cantonment board will be included while computing the tax liability.
The standing committee recommended put the burden of proof on the department. The way the GAR provisions have been brought in the finance bill and the way they were in the direct tax code bill, put the burden of proof on the assessee. So you really have to prove your innocence, and you are guilty unless proved innocent, whereas the law should be the other way around. Similarly, if the provisions, as I said, become a noose around the neck of the taxpayers, then the taxpayer will certainly be agitated. So the provisions need to be fair, transparent, and the provisions must be simple to administer. They should not leave discretion in the hands of the tax department.
The proposed tax code prescribes stiff penalties and prosecution for non-compliance with the tax laws. It proposes that every tax offence under the code will be punishable by both imprisonment and fine. Apart from defaulters, the direct tax code proposes to punish tax consultants who help in tax evasion. Under the direct tax code, income slab of women is equal to man, which means from now women has to give equal tax as of man. With camera person Virendra, Aruna Thakur, Rajya Sabha TV.
The bill proposes that the anti-avoidance rule provisions will be subject to approval by a dispute resolution panel, which will consist of 3 commissioners of the IT department. But the Parliamentary Standing Committee recommends that the review should instead be done by an independent body to ensure that the system is fair and just. Fair and just. But we'll come to that point again. My question to you, Mr. Venkatraman, is, do you see this bill as really simplifying the existing tax laws? Has the bill seeks to do this?
The answers are twofold. As far as consolidating the past history of income tax legislation and moving forward, it has done a lot of revolution. As far as the new enactments such as GAR are concerned, it does attempt to do a noble thing, but the whole the result depends on how the tax administration translates it. You are talking about dispute resolution mechanism. I think we should answer that straight.
Yeah.
This is in place for the past 2 years in a limited way under section 144C of the Act. And to our knowledge, there is a concession by every officer who sits in DRP that we have not been able to give the justice as demanded or as it is required to be, because our hands are tied. It has never, 9 out of 10 cases has been held only against the assessee. So my simple answer is, may it be GAR or may it be any other anti-abuse provision, the first 2-3 tiers of the tax administration will not be able to render any justice. Simple reason, there is a conflict.
Yeah.
They are the tax collectors and they have to administer justice.
Yes.
So they can't do both.
I get it. Now I'll bring in Mr. Sanjay Agarwal. Mr. Agarwal, on the units of one business being asked or the attempt being made to ensure that they compute their separate units, even if there was one business separately, how is it going to impact the existing? Isn't it going to increase compliance? And second, why is it required?
You see, the question of compliance will certainly arise because in some of the cases, the large number of the businesses are involved. The way it is worded, it is to be improved, and it is not possible at so many times, and the ICAI has categorically said, look, category wise, if you want that I should give a separate business requirement or segment reporting is there, that is something different. But if you want that I should give between the head office and the sales office the different accounting practices and different accounting balance sheets, etc., that is impossible. It is
but
not
the 3
possible.
parameters that they have laid out, is that enough guidance to help compliance?
Not at all. Not at all, because ultimately it is the income of the assessee per se which is taxable. It is only for the data mining or the analyzing. If you want to have the information, that is something different. But so far as the taxability is concerned, it is per se the assessee in totality, because ordinary sources of income is to be taxed together. So there is no, you can say, enough outcome will come by asking the assessee to prepare even tiny information and then providing that in the, it is a, you can say, Herculean task in respect of very big businesses.
And implementation is going to be very difficult.
Very difficult.
Okay.
Very difficult.
I'll come to the wealth tax bit. Do you think the way the wealth tax has been included, and also certain extra parameters have been created to ensure that proper reporting is done? Anything you would want to add to that?
Answer is this. Reporting is a state of mind. And you enhance the limit even to 10 crores.
Yeah.
And give them the best safeguards. People who don't want to report will never report.
The standing committee eventually has asked it to be 50 crores.
Yeah, could be. You enhance it to anything.
Yeah.
But as I said, wealth tax, gift tax, all these are all now has become minor levies. They are insignificant considering the total tax impact on the economy.
Yeah.
So going forward, these things needs to be regulated to whatever extent possible. You can bring people, rope into the system and govern it. They are not going to cause a great impact unless otherwise they are people who launder, who are in black money.
So it's basically a measure to counter that. On that note, it's time for us to head into a break. When we come back, we will show you an interview with Mr. S.R. Patnaik, direct tax expert, Luthra & Luthra. Welcome back. My colleague Aruna Thakur spoke to Mr. S.R. Patnaik, direct tax expert, Luthra & Luthra, and tried to get his point of view.
The Direct Tax Code has the very objective to simplify tax laws. Is this objective being taken care of?
code bill which is being presented to the Parliament and which has been commented upon by the Finance Committee, it has a significant number of forms and annexures that are there, and a number of rule-making abilities have been delegated to the CBDT, which is the administrative body. Now that is not, to my mind, simplification. That is basically giving more and more discretion to the tax administrators, which to my mind is not a thing in the right direction, because ultimately the people who are responsible for lawmaking should be answerable to the Parliament and not the tax administrators who are not directly answerable to the Parliament.
The direct tax code is basically mooted for the GAR, that is anti-avoidance rule. So what will be its implication?
Very few countries have introduced GAR legislation, and even fewer have succeeded in effectively implementing GAR legislation. It is supposed to be invoked only in the rarest of circumstances, and it is not a general anti-avoidance regulation that would be invoked at every point in time.
The Standing Committee has already given its recommendation on the direct tax code. So what are the key recommendations which according to you, are the most important?
It is desirable for the government to seriously consider some of the recommendations made by the Finance Committee, especially in relation to increasing the tax limits for individual taxpayers. They should also consider seriously the changes that are being proposed through GAR, through CFC regulations. Some of the welcome changes are linking the incentives to investments rather than to profits, which would simplify the tax exemption and benefit calculation significantly.
The bill proposes to tax shareholder funds for life insurance companies at corporate tax rate of 30% as against the current rate of 12.5%. The Standing Committee recommends that instead of 30%, the rate should be increased to 15%, as taxing them at a higher rate may discourage promoters from investing in life insurance activities. Now, my question to you, Mr. Venkatraman, is, see, what is the point of DTC being brought in when most of the most effective parts have already been made a part of the finance bill? Is there any relevance of the DTC now?
It's a very, very pointed question. See, interestingly, March 9th, 2012, the Standing Committee releases its report on DTC. 16th March, budget is tabled, and the finance bill is brought out, and most of the essential critical parts of DTC is forming part of the Finance Bill 2012, minus the recommendation of the Standing Committee.
Yeah.
That's important. So, two questions. What would happen to the recommendations made by the Standing Committee? One. And two, except for residency rules, this controlled foreign companies, hardly 3-4 items. Everything is now part of the Finance Bill 2012. If you introduce these things also, when Income Tax Act is on the verge of an exit, that's the assumption all of us had, you dump more and more of the DTC content the way you want it. And we are now not sure whether it's an exit of Income Tax Act or the exit of DTC.
Okay. Now, the point I wanted to ask you, Mr. Sanjay Agarwal, was GAR and also the backdated overarching elements that have been inserted into the finance bill. Backdoor entry legislation making it part of the entire budgeting activity. How do you see it?
You see, so far as I think, the DTC, there are two things which challenges are before the professionals, before the income tax compliance officers, that whether to learn the new act, because there is a completely change in the numbering. They have to keep in their mind while legislative being implemented the old law for 5-10 years more, because the old law will be there, and then at the same time remembering the new section. So I think the remembering of the two sets in the mind, that is more or less in the budget, they have brought it, you can say the DTC in the finance bill itself.
Okay, I get it. Mr. Venkatraman, one last question is on the backdoor insertion and also retrospective effect implementation of various tax provisions. What is it? How is it? Quickly, please.
In three bulleted points, GAR and the retrospective amendment. What are you going to do? How are you going to resolve favorable tax treaty versus GAR? Two, how are you going to resolve the contradictions, the permissible transactions in under a treaty vis-a-vis which are considered to be totally impermissible under the GAR? So the overreach. Are you going to say that therefore the Act says, the GAR rule says that the treaty benefits will be ignored and the transaction will be considered to be only impermissible. So you have a contradiction. The system maintains a contradiction. The second point. And the third important aspect which you have been highlighting all along, that the mechanism and the tax tool administration, how they are going to implement. The last point on retrospective amendment, you apply GAR on retrospectively. How do people would have already structured and brought the transaction unknowingly?
Yeah.
Now you're going to say all your transactions are now an impermissible tax avoidance. It's going to
open a can of worms. And
besides
compliances are going to be impossible
and
to
if
achieve.
Tax administration is not going to do it in a very responsible way, it will have a stronger impact on the economic growth of the country.
On that note, it's time. Thank you very much, sir, for joining us on this discussion. It's time for us to end the show. You can email your suggestions and comments to law.rstv@gmail.com. You can also watch our shows on the YouTube. We'll be back with a new issue and a new episode. Keep watching Rajya Sabha TV.